If you look at the Indian retail investment landscape, you generally start on the ground floor. A young professional earning a standard salary might set up an SIP, a systematic investment plan, putting away 500 rupees a month into a basic, reliable equity mutual fund. It's accessible, simple, and meant for the masses. Compare that to the absolute peak of the market. Ultra-high net worth investors skip mutual funds entirely and hand their money to portfolio management services, or PMS. To even walk through the door of a PMS, you need to write a minimum upfront check of 50 lakh rupees. In exchange, you get a highly customized, aggressively managed portfolio. But that leaves a massive, unaddressed space in the market. Think about the seasoned investor who has outgrown their standard mutual funds and is sitting on a surplus of 10 to 15 lakh rupees. They want more sophisticated strategies and slightly higher returns, but they cannot comfortably write a 50 lakh rupee check to a PMS. That specific investor is exactly why the Securities and Exchange Board of India, SEBI, introduced a brand new regulatory category between early 2024 and February 2025. They call it the Specialized Investment Fund, or SIF. The rules for entering a SIF are strictly defined. The minimum investment is exactly 10 lakh rupees. And to protect investors from fly-by-night operators, SEBI mandated that these funds can only be offered by legacy institutions that already hold a valid mutual fund license. This pyramid diagram shows the wealth management hierarchy in India today. At the wide base, we have mutual funds for everyone. At the tiny peak, we have PMS for the ultra-rich. The SIF slots perfectly into the empty space between them, giving the middle-tier investor direct access to elite wealth-building strategies. To understand why a SIF is an upgrade over a mutual fund, we have to look at how mutual funds actually make money. Standard mutual funds operate on a strict long-only mandate. This means the fund manager buys a stock and holds it, waiting for the price to go up. If the broader market crashes, the mutual fund crashes with it. A SIF removes that limitation entirely. The primary advantage of a specialized investment fund is the manager is legally allowed to take unhedged short positions. This line chart tracks a market index falling over time. While a standard fund would follow that red line downward, a SIF manager can actively bet against struggling stocks or entire sectors. If their analysis is correct, the SIF can continue generating profits, tracing that upward green line, even when the rest of the market goes sideways or enters a bear run. The mechanics of shorting are straightforward. The manager borrows shares of a stock they believe is overvalued and sells them at today's high price. When the stock price inevitably drops, they buy those shares back at the cheaper price, return them to the lender, and keep the cash difference as profit for the fund. By utilizing this mechanic, your portfolio is no longer a passive victim of a market crash. It becomes an active beneficiary of downward trends. Unrestricted short selling carries intense risk. When you buy a stock normally, the worst thing that can happen is the price drops to zero and you lose your initial investment. But if you short a stock and the price unexpectedly skyrockets, your losses can theoretically run to infinity. This portfolio pie chart illustrates SEBI's primary safety mechanism against that exact danger. A SIF manager cannot short their entire portfolio. SEBI placed a hard cap on unhedged derivative short positions at a maximum of 25% of the total fund size. For the remaining long investments, SEBI added a secondary guardrail. Exposure to any single company's stock is strictly limited to 10% of the total assets. This ensures that a single bad bet on one company can never wipe out the entire fund. Operating within those limits, a SIF will fall into one of three distinct categories. Managers run an equity long-short fund, a debt long-short fund, or an active asset allocator, a highly dynamic hybrid fund shifting seamlessly between equities, debt, commodities, and real estate trusts. The resulting structure gives retail investors the aggressive, tactical tools typically reserved for private hedge funds, fully enclosed within the safety harness of government regulation. We know SIFs are an upgrade over mutual funds, but if an investor actually has a large amount of capital available, why would they choose a SIF over a highly customized elite PMS? The answer comes down to fees and taxes. Like a mutual fund, a SIF charges a flat expense ratio, which is legally capped at a maximum of 2.25%. They are entirely barred from charging performance-linked fees. A PMS, on the other hand, typically charges a fixed fee plus a cut of the profits if the portfolio performs well. But the real hidden cost of a PMS is taxation. In a PMS, you directly own the underlying shares. So every single time the manager sells one stock to buy another to rebalance your portfolio, you, the investor, are immediately hit with a capital gains tax liability for that trade. This split-screen diagram compares the two models. Because a SIF is structured like a mutual fund, internal trades are tax-exempt. While a PMS portfolio bleeds capital gains tax on every transaction, you only pay tax on a SIF when finally withdrawing your money. By eliminating the friction of individual trade taxes, a SIF allows an investor's wealth to compound continuously, keeping more money actively working in the market. Before making any moves, there is one undeniable downside to consider. Because the SIF framework was entirely formalized between 2024 and 2025, these funds have absolutely zero historical track record. You cannot look back at a 5-year performance chart to see how they handled a recession. Furthermore, the success of a long-short strategy doesn't rely on general market momentum. It relies entirely on the individual skill, timing, and trading execution of the fund manager operating inside these institutions. Because of this reliance on active management, a SIF should be viewed as a complementary tool in your portfolio. An investor should never sell off their core, reliable mutual fund holdings to completely finance a new SIF. The perfect candidate for this category has a strong financial base, an idle 10 lakh rupee surplus, and seeks protection in sideways markets in exchange for slightly higher risk. For decades, retail investors were locked into simple products, while ultra-high net worth individuals utilized advanced financial mechanics to accelerate their wealth. The launch of the Specialized Investment Fund closes that gap, handing institutional-grade wealth tools directly to the middle class.